In previous lectures, we talked about the main types of financial instruments. We talked about bonds, equities, derivative securities. In financial markets, participants often talk about asset classes to group securities. Now, you might have even heard of traditional asset classes versus alternative asset classes. So what is this distinction? While the definition of what constitutes as alternative assets is a bit fuzzy, it's probably simpler to define what they are not. Typically, stocks, bonds, cash, and cash equivalents are generally viewed as traditional asset classes. In any country in the world. Now, typically you can think of everything else as being alternative. The boundary between what is traditional and what is alternative has also shifted over time as some alternative assets have become more familiar and migrated into the traditional space. So for example, in early 1980s, all non-US investments could have been considered alternative. But now they are typically just viewed as a subcategory of equities. Like for example, emerging market equities. Once alternative, probably now just another subcategory of equities. Similarly, traditional asset classes may also now include less liquid and riskier groups of equities or bonds that were once considered alternative, such as high-yield bonds or small stocks, microcaps, right? These were once considered in the realm of alternative assets, but probably just subcategories of traditional asset classes now. Now, the big four alternative asset classes today are real estate, commodities, hedge funds, and private equity funds. Right. Alternative assets have become very popular in the 2000s, especially because investors were attracted to these assets because of their potential return performance and diversification benefits, at least in normal times. In 2008, however, most alternatives failed altogether, both to diversify and improve returns. Now, real estate and commodities, which are real assets and are clearly distinct asset classes, are typically added to traditional portfolios for their diversification and inflation hedging properties. Real estate can be accessed directly through less liquid physical markets or indirectly through property stocks or real estate investment trusts, REITs. The long-run return of real estate is probably somewhere between those of bonds and stocks. An interesting and growing subclass of real estate is infrastructure investments. This can be considered a part of or related infrastructure, right? You can think of this as being related to real estate, but it is increasingly seen as a distinct asset class. These are investment pools specifically targeted to finance major projects and can offer an investment alternative to institutional investors with long horizons. Right? Infrastructure investments, what are the sources of risk? Well, construction, operations, regulations, legal, and political environment can be thought of as diverse sources of risk. Also, liquidity and lack of transparency may be some concerns for this asset class. What are infrastructure assets? Well, they range from transportation, such as bridges, ports, to utilities, to communication and energy projects. Now, commodities are perhaps the best diversifiers of financial assets and also provide the best inflation hedges. Now, whether private equity and hedge funds should indeed be considered as asset classes or can be better characterized as active investment strategies is a very relevant question. I personally I'm not very fond of calling them as separate asset classes. I consider them as investment strategies. Traditional versus alternative asset class distinction is one that still gets used often. But I will encourage you in later classes and modules, as you will see, to really think about what drives returns than this artificial distinction of what constitutes asset classes. What's more important, as you will see, is what risk exposure they have and what drives returns.